All right, we are good to go. Microphone's live. Just testing out some audio right now. Okay. Cool. Hey everybody. No audio. I think we got that fixed. All right. Well, welcome. My name's Kojin, and I'll be going over earnings, what I look for, kind of how I play it. So right now, I kind of want to get started off with what I use. I use TradingView, my Robinhood account, to look at options and like strikes, directions, pricing, and then the NASDAQ earnings calendar. I also use Yahoo sometimes too, but I've recently fell in love with the NASDAQ because it kind of has a little bit better organization. So we'll go back to here, and this is Monday. So what I usually do is I kind of like select the day. Actually, I do my Monday research the week before, because I want to make sure that if I can get in on Friday for anything that's pre-market, then I want to be there before they release earnings, before they run up. So later in the week, I will look at Monday, and then sometimes I'll dive into Tuesday. But the sun right here is like basically your pre-market earning plays, and then the moon is your post-market, so after hours. NASDAQ actually goes ahead and just organize like the large caps at the top, and then like basically your market cap, and then they go down. So Amgen is like the highest market cap on Monday, and for those that are like, okay, what the hell is Amgen? Well, you can go down and you can see, oh, I know what Tyson's food is. They sell chicken nuggets at the grocery store. Here's a semiconductor place. Chips are hot right now with the EVs coming out. And then you can keep going down. Hasbro, they make child games and kid stuff. So you have tons and tons of companies that you can get lost in. Energizer, this company sounds cool because they're called the Matrix Service Company. I mean, is it a good company, or is it just cool because it sounds cool? So this is what I usually do. I look at the consensus EPS for the forecast, and then I compare that to last year. So looking at Amgen, you can kind of see that 381 is their last year's, and then their consensus this year is 414. So that's obviously obvious good growth. So what I'll do is go into my TradingView free edition, lots of ads, and I'll look at the chart. So I'll kind of see how it's been running, how far the company goes back. Okay, so this is an older company. I can keep going back. Looks like they've been around for a while, right? So I don't get lost in all that stuff. What I do is kind of see just an overview of the original chart. Then I come over here on these stats, look at the volume. We have 3.16 million volume. That's average per day. So this company does get a decent amount of volume, so it's not like a small volume cap. And then we look at the market cap, 125 billion, and then we kind of go down here, and then we look at their kind of finances. So before we dive into that, I just want to say hello. How's everybody doing tonight? I hope you're doing well. This is my first time actually talking about my play style for figuring out earnings, but I do want to create more content in the future. So if you do get anything from this stream, show me some love, and let me know if you have any questions, but I'll try to like stay on topic throughout the stream, and then we can go through I'll answer questions later on. So now we're looking at Amgen. Like, what is Amgen? You can come down here, you can go through the company, like what it is. It's a biotech company, engages in discovering, development, manufacturing human therapeutics. So that gives you an idea of what it is. And sometimes, like, if I really want to know more, if it fascinates me, I'll just go boom right to their website, and then I'll even select the investor tab or the investor relationships, and you can just dive right into like their presentations. I like looking through company presentations over, you know, anything else, because I can just go back to TradingView and look at the finances myself. So annually, they made 25 billion in 2020 and 7 billion net income. Profit margin looks good, right? So I just take those numbers, 25, and then we look at these last 3 quarters. So, you know, 5.9, 6, so call that 12.5, and then 18, maybe we'll round that up to 19. Let's just say that they have another quarter of 6, so 25, and then boom, so they're even with revenue from last year. You know, net income 1.8, 400 million, 1.6, so 3.5. We'll just say 4.5. We'll say 5. So their net income looks like it's a little bit lower, but we're just predicting the quarter 4. We're just guesstimating in a way. So we don't technically know what's going to happen with Q4 for 2021 until the earnings report. Do we like the company? I don't know. That's what research is for. So obviously you can select Tyson's Food, because I mean, you know that company a little bit more, but you know that they sell, you know, frozen chicken and, you know, food. And can you like compare that to like what's going on in the market, what's going on in the current events, you know, with the destruction, distributing like laybacks, you know, the inflation of pricing of food and chicken and stuff. So you can think about what's going on in current events and take that to play into your plays as well. So with Amgen, I don't know, I thought it was an interesting company. Looking through their presentation, their pipelines, I guess what I usually do is kind of browse. I don't want to spend too much time talking about this company, but you know, you can look at, let's see, you can see the news and events, press releases, presentations. So here's their presentation, and you can basically just go back to, these are earnings presentation. We can just go to this, the most recent one, and just use like your arrow keys and just kind of skim through it real quick, see what they're all about. So they have human data, they're into research, biotech, therapeutics. You can see if they're affiliated with any health companies and stuff like that. So as far as like getting lost in this company, you know, we won't do too much of that. We'll kind of move to the next one to keep things interesting. So yep, that's your largest market cap on Monday. So going down, you can be like property, real estate. Do I really want to look into that? Does it really appeal to me? No, but you know, Tyson's Food is kind of interesting. They're kind of even with their last year's EPS. So we can just go into TSN for Tyson. Look at the numbers for the Q4, Q3. So you can see that they're growing, and this is probably because of the pricing of food has gone up so much. So either way, you look at their chart. So they're at all-time highs right now. So right here was their last all-time highs. That's your COVID boom, or your COVID sell-off. And here we are, exceed to all-time highs, and we have a little bit of sell-off. Looks like they're down here on this like stability zone. So do you play these earnings with their chart? in their numbers, you can be like, well, they're already at all-time highs, you know, even if they meet earnings but don't like blow them away, you know, they could come down to a lower support. If they blow their earnings away and have like forecasted for 2022 and everything's really looking good for the company, and they'll be like, you know what, we're gonna make money, but we're gonna drop the price of chicken, and people are gonna be like, what? So you could see another run up to push all-time highs to create a double top. You can use your chart logistics and make your own kind of guesses with that. So say that we think that Tyson's going to do good, and we kind of want to see where we can go. So a safe bet would be like, yeah, I see them. Like if you did this last week, since it's a Monday pre-market kind of earnings play, and on Friday you're like, yeah, I definitely. What Friday would have been the perfect day to do calls, because look, they have a red day, they finished down at $88, and you're like, I know they can go up to test all-time highs, but I want to play it safe, so I want to choose like the 90 mark zone. So we can go into our broker, whatever brokerage you use, and you know, this, if you had this play in mind on Friday, you'd be like, where would be a good buying opportunity? It definitely wasn't early. I mean, if you were that excited, it's always good to wait on market open for swings going into the next week. Market open plays for earnings are like after earning reports. Like if you know like a company already really came out with the earnings, buying on the market open is good if you're gonna monitor it and like get out, exit immediately if they have a sign of reverse after they're kind of like going up or down. But it's a little tricky. So say that we were like, yeah, let's play Tyson, and at like, you know, around sometime today we were like, well, let's look at call options for the next week, but they don't do every week. Some companies do once a month. So when you have February 18th as your strike, you think about it, you are further out, so you have more time for the option to expire, so the premiums are going to be a little bit higher. So instead of, you know, so if you look at the 90, we were very interested in the 90 because we're like, yeah, if this runs good, then I mean, I think that the 177 would be a good price for me. You know, I'll actually just buy one contract of that. And actually, if you see it today, because of the red day, they lost 34% of their volume. So you think about it, that buying calls on a red day, your premiums are cheaper and you get more bang for your buck. Buying puts on a green day is the same thing. So click this $90 strike because we talked about it, we liked it. It's, you know, if you wanted to go a little bit further out of the money and test all-time highs, you know, you could be like, I think you'll go to 95, right? And you know, your premiums are much cheaper. And the thing is, with the expiration being February 18th, you can make really good money on these cheaper ones because you can load up on more. But playing earnings and buying more than one contract is very risky. So sometimes you don't want to risk a lot of your portfolio by doing these kind of things. So buying one contract before earnings is very safe, because if you hit it, then you make the money for that one contract. If you miss, you have the option to exit with, you know, as you know, if you lose money, or you can average down if your strike price is further out and you're like, well, I know it's going to reverse, let me average down, and then, you know, you immediately cut the price of your contracts in half. Now we look at the play. Implied volatility is what I usually go for immediately in this market. 39% is very nice. You want it under like 60%. So 39 is very appealing. Yeah, I'm not going to get into like the whole Greeks, but you can just kind of compare that. I think, you know, with good earnings, hits 90, you know, I'm willing to risk this for that play. So what I usually do is, since it's the pre-market play and we are not in this play, I'll add this to my watch list. And by doing that, Actually, I shouldn't have done that, because they don't really load watch lists if you're not in it as fast on the desktop version. But adding that to the watch list, I can be like, wait till the earnings come out, and then I can see the price fluctuate and be like, hey, did they sell off? Did they run up? Are they running up? So I can get into the play after their successful earnings, and or it gives me a chance to be like, well, I'm glad I didn't get into that play because they went the opposite way. So back to it, let's get into it. So when I do this, I kind of go quick. I kind of just want, like, see companies that appeal to me. So ON Semiconductor, don't know much about it, but that growth from last year to this year, that's a 3x. That's actually, seeing those numbers are really good. So immediately I'll be like, okay, I want to know a little bit about the company. So we'll go into trading view, and immediately with these kind of stocks, you're like, semiconductors, they're running hot, right? Nvidia, AMD, Micro, LRCX or LCRX. I'm a little dyslexic, so I could be switching that around. Chips are doing well, except for Intel. I don't know why they're struggling, but they just are. So you can kind of look at their chart right away, look at their numbers, see what they do. So they do, they're a supplier of power and analog semiconductors, for energy grids, auto vehicles, looks like it, 5G cloud infrastructure. So you can learn a little bit about the company by just reading this little bit of a profile. And if you really wanted to get into it, like I mentioned with Amgen, go into the website, go scroll to the very bottom, check out their investor relations, see their kind of news, their catalysts, their finances, whatever you want. If you really want to dig more into the company, let's just pretend that we like this company a lot, and we'll set up another call option, like a call option potential, because we think that chips are hot and we want to play this. We look at all-time highs. It looks like they sold off, they bounced, so they stabilized, but they also bounced up. I see like the next resistance around 65 to 66. So let's go in and check out their kind of plays. All right. So with Amgen, I think it was like more expensive. This is, the lower you get in your market cap, not all the time, but the pricing usually goes down. Since they ran up Friday and their earnings are actually in the pre-market, this is a play that if you wanted to play the actual earnings, you would get into last week. But playing before earnings come out is a coin flip. You can have all this due diligence, you can have like your mind set to a way it's gonna go, and then they have the earnings and they beat. They have amazing earnings, they have great news, and the opposite happens. So you can't really same thing happened like last week or like the week before. I mean, Netflix, they were hurting, but they were increased from the year before, but they had news of like they're losing their subscribers, and boom, it took off, like, or no, it fell 20%, 25%, and then the next day it fell another, like, or on that Monday it fell another like 7-8% within the first hour, and then it went back up. Tragic, especially if you're holding shares of a company going into these earnings. Facebook, Meta did the same thing. So it fell really, really hard. Amazon and Google, great earnings and they took off. You don't see these large caps go up 10%. 10% on a large cap company is like a few $100s. That's a big deal. So with this semiconductor on, we really like the $60. But see this? Since it was a green day, this ran 78% just on Friday. So that means that this was priced at like 150 or like 125 or 1.25 per share. So you buy a contract for 100 shares, right? So that's a big jump. So you kind of like think, darn, I don't want to risk it anymore because the premiums are a lot higher. I missed my chance on Friday to get into their pre-market kind of earnings, but I still think the company's going to do well. If you had the opposite kind of mentality and you think that they're going to sell off, look at the strikes lower. Why are they still expensive? That's 11% out of the money. Well, we were looking at the 6% out of the money for 285. We go to puts and 285, right? Look at this, 11% out of the money for 278. That's almost 6% or 5% more out of the money for the same price going the opposite direction. That's insane. And why is that on a red day or green day? Why are the puts jacked up like that? Well, let's look. Implied volatility is 150%. So the volatility went up because this was maybe heavily traded on Friday. So like if you got in early, you could have probably just even day traded that and got out end of day for, look at that, 20%, 50% on this strike. You come down here and you even have 32%, 20% here. And then the further away you get out of the money, Netflix fell 20%, Meta fell 20%. Why shouldn't this company fall 20%? Going more than 10% out of the money for an earnings play is super risky, especially if you are dealing with the expiration of that end of week. So we know that next week is the 7th through the 11th, right? So Monday's okay, like getting into a play on Monday is fine. Getting into play on Tuesday is, okay as well. But when you get into a play on Wednesday or Thursday, it is so risky because you're getting closer to your end of week. Your premiums and will get crushed by volatility, and if the stock goes the opposite way, you can expect zero for your contract. So it hurts when you put in like a couple $100 and it goes to zero. So it's better to kind of use risk management. Do we want to play this semiconductor? No, we do not. We do not. But this might be fun to keep an eye on after earnings to ride the wave of the hype, or see it run up and then ride it back down. Because usually when stuff happens, like they have good earnings, they're up 10% pre-market. Then within the first hour of the market open, they go up another 7-8%. Then at 11:30 or 10:30 or before noon, like they reach their top, their apex of their earnings, the run up and the after run. So then you can ride that back down. So it's just there's so many different ways to play earnings. You don't have to play before the actual earnings itself. That's more risky, bigger rewards. So you can always play after earnings. So with this semiconductor, they got 8.9 million volume average, and then their volume on Friday was 10 million. So that's actually great volume. You got your market cap right here, 24 billion. You look at their finances, you see that they're making lots of money. This is huge. Look at the profit margin per quarter, 1, 2, 3. Those look great, right? They made 5 billion revenue 2020. They got 1, 2, they got 3, they got 4.5 right there. So they're definitely going to beat their 2020 revenue. They might maybe even beat their 2018 revenue, which is huge for the company. So these are things to look forward to. Let's keep moving. All right. So, what else do you see? Like, obviously, we'll try something besides a pre-market on Monday, because we can't get into that play, correct? It's too late for us to get into a pre-market earnings play unless we play it after earnings. So let's look at these ones. They're beating last year. That's nice. They're losing. I don't know. It's a software company. Right here, Credit Corp, 2.28 to 3.36. That's actually a big beat right there. That's very nice beat. Tenet Healthcare, even from last year. Nothing very exciting, right? Okay. All right, let's look at this. So here we have Chegg. This is like a pretty popular momentum kind of play. A lot of people were like, did y'all play Chegg last time? Or like, or were y'all playing it when it fell 45%? Well, why did it fall 45%? Is it because of COVID? Is it because of their finances? I don't know. Let's check it out. I don't know anything about this company except that they do stuff with tutoring, and it's a company in the US. So you saw what happened in the Chinese sector with tutoring companies. They cracked down on school and tutoring, and they kind of banned it, and all those companies in the from China went to like penny stocks, and they used to be trading at like 12, 13, 25, 32, 45, $50, and they are now penny stocks. You can also think about those kind of things when you're coming into these kind of plays. Like, look at this gap. This is obviously an earnings, because you can look at TradingView. November 1st, they came out with their earnings, right? So the thing about that is, look, they had great earnings, or they went up for their earnings. That means the next day they fell. That is insane. You don't see these kind of things. So kind of looking at the chart, be like, wow. So they had earnings, then they ran, and then they just fell over and died. Like, this is ridiculous. Look at this line. We can even just go to the very bottom of this, right? And we'll go to the bottom of that. Let's make this like, I don't know. I like making it yellow. And let's just imagine that happened over here. That's a 40% drop. Oh, if they fell 40% at $26, or if they fell this much at $26, they would be bankrupt. Is that realistic? Probably not. So seeing something like that is just crazy to think about. So what is the company? It's a learning platform for students. So you think about it, students are returning to school, so classrooms are becoming full again. Mass restrictions are a little bit less hesitant to be very strict, and the decline in COVID cases are coming down. It's if you've been watching the news, COVID cases are falling. This is great. This is really good. So you think about these kind of things. Is this company going to lose money because more people are going back to the classroom? You kind of like think about current events. You think about, kind of wrap your own ideology around these kind of things. And then you think about looking into the actual company itself. You can go to their website, check out their finances. You can look at their annual, look at their revenue, 2020 revenue. They had -$6 million income, -$9 2019, -$14. Wow. Bad. But they're getting out of debt, it looks like, right? So slowly but surely they're getting out of debt. and they're increasing their revenue by like a little bit, like 200 million, 150, 250. So let's look at this year. 644 million was their last year. 170, 190. I guess that's like what, 270, and then 470, not including the new year or the new quarter. So say that they did the same thing as their last quarter, so we can say about 570, 670, maybe 650. So right there, they're pretty much even with their revenue with our kind of our estimating their quarter four, right? Let's look at their net income, because that's all been negative. So you have negative 65 million right here just in the first quarter. 32, so they're halfway up. 6, so they're still in debt. So they haven't been able to gain the net income volume they need to get out of debt. So could they still be like a net income of negative depending on their fourth quarter? If that's the case, do we see a lower low? And if you look back, you see where that is now. This line is where they are now. They came in, this is their IPO release, 2013. So this company's been around for a while. We can actually just go ahead and draw a horizontal line and be like, well, if they're at this line, then what happens if they hit this line? That's their resistance right there. If they fall any more, I mean, yes, it's their lower, but if they fall any more than that, they would have that resistance to fall against. So you can play this both ways, right? If you think the company has something good going for it and it's growing, or do you have some catalyst in news? Is it, hey, people, I heard like some sort of company was gonna buy this, right? Like, you know, when Amazon and Nike said they were gonna like maybe look into acquiring Peloton, what happened to that company? It took off, you know, 30% after hours on a Friday. You know, no one expects that, but those catalysts and news will do big things for companies like this. But look at the average volume of this company, 3.8 million. So it's not heavily traded. It's not like your big Apple or Tesla. You know, those companies have, you know, 10, 15, 25 million people trading that every day. Then you can kind of dive into the options. Let's look at the options. You know, people went 70% out of the money for, which is ridiculous. So $26 is your share price. You know, let's go back. So we have a green day, went up 5.5%, right? So if we think it's going to go to $30, from $26 to $30, that's 20% to break even. So it's given us our break even price at $31.63, which is a little bit higher than I like to see. I like to see it closer to that strike price, like so like $30.50 or before. So what platform or site is this? So I use Robinhood for my options, kind of looking through my options, because that's my brokerage and what I use for trading. I use TradingView for charts, and I use Nasdaq.com to find the earnings in the list. So going back to this, so we have another high IV, so high implied volatility, 150%. So that means that this was getting kind of expensive on Friday. However, we think the company's going to sell off again. Don't you? Like, in my opinion, looking at the finances and stuff, you know, they're not doing anything that they weren't doing from last year. Nothing big or exciting. But we don't know their earnings at the moment, but looking at the last few quarters, we're like, yeah, nothing really big and exciting. So I think this company could go back down to sub 22, because that was our resistant line from our recent lowest low, right? So let's look at the 2250 strike. And for February 18th, Boom. Got 166 applied volatility, so this was actually hot. Let's just go to March. Same price. What? That doesn't make sense. So the 2250 is $138, and you add 30 days, it's only 163. The implied volatility is 60% less than the last one. Wouldn't it make more sense to buy the March put instead of the February? That way, if the earnings are good, you're not digging yourself a grave. You get a little bit of time to, average down or, sell this for a minimal loss instead of a bigger loss. So choosing a different expiration date, even though like some companies have month to month, you can do another week out or 2 weeks out, and you can kind of compare the volatility with the premiums so you can get a better idea of like the risk and reward ratio, correct? So that's 21% out of the money right here. What happens if this company fell another 40%, right? What happens? You can be like, well, I kind of want to take a gamble here. I look at the March 18th, or let's look at the February 18th for 40% of the money. $13. March 18th, 40% out of the money. $23. That is dirt cheap. You can buy one contract of this. You can make, say you made like, $200 trading last week. And you're like, well, I kind of want to do one little lotto play, and I just want to do the March Chegg put for $15. See what happens, what happens if it sells off 15-20% after earnings, and you're like, your $23 turns into, 65-70. That's a 3x. You can be like, you can sell and you can leave immediately. You don't have to wait till March 18th. You're like, well, I want it to go in the money. I want 1,000%. I want 2,000%. Sometimes when you play earnings and you see 20%, 40%, if you see 100% and you don't secure that, and the trade like changes on you because the next day you got a lot of volatility, you can't point the finger at the stock market. You have to be like, that was my exit. I could have secured 100%. Why was I chasing 1,000%? Yes, it's really nice to hit those lottos where the price swings 20% and your $23 put goes up to $600, and you're like, what? That's insane. It happens. Trust me, it's easy to get those plays, and it's hard to see them, and you have to look. It happened with Netflix. It happened with Facebook. There's plays that were, went from, under $30 to, $1,000. So they're out there, but the only way to get those is by taking the risk and reward for earnings. So that's it for Monday. We're bored. I mean, obviously I can do this all night, right? I could be like, I want to go in, I want to check these small caps, I want to look at the Matrix because of the name sounds cool, and look, they're going from negative 0.03 to negative 0.28, so they're losing more money. Let's short them. You can have that kind of idea. But right here on NASDAQ, that's just Monday. All these companies are just Monday. It can be excessive. So spending time going through all these companies can be just super boring. So let's go to Tuesday. Oh, here we go. We got Pfizer. We got BP Gas. We got Fiverr. I thought that was Fiverr. We got we got Chipotle. We got Cisco. We got a company called Yum Brands. I don't know, but you have more familiar companies that by going through this. But look at this, all the way down here. You have Lyft. So they're in debt. Looks like they're cutting their debt in half. We have Peloton. So funny story is I was looking at this play last week, and I was getting excited going into this play, and I was like, wow, this company is going from hero to zero so fast. If their last year they were like barely profitable, and this year they're just negative 1.18, that is rough, right? That is horrible. This is one of those stocks that just went up during COVID. It was definitely a COVID stock. This is, look, the company came out right here. This is their IPO release, and they reached a high of 37, and they started out like under 20, right under 20. This is COVID right here. They didn't even fall that far. They went to $18, but go from $18 all the way up to 138, fall down to 95, then back up to 180. That is one hell of a run, and that was in 9 months. I'm sure this stock was talked about everywhere all over the news, being like the hot stock, Peloton. But you think about it, where did they go wrong? Well, this is where they went wrong. Look at these numbers. Bad governance, bad financials, and maybe their product was too expensive, so it wasn't appealing to everybody. Not everybody can be like afford a $10 Netflix subscription, or not everybody can afford a $10 Netflix subscription, but definitely no one can afford a $6,000 exercise bike and then pay another, I don't know, $50 a month for a subscription. So they definitely had their pricing just way jacked up. So I was liking this chart a lot just because of how bad it is. And I was like, wow. So $4 billion revenue in 2021, negative 189 million net income. So they're reporting New Year, right? Look at their New Year's. Look at this, negative 313 million net income in quarter 4 2021, then negative 376 million in quarter 4 2020, or quarter 1 2022. That is so bad. Like, and then they're coming out with, that their consensus is still bad, So is this company, should it be priced at this? I don't think so. If it does run up, where could it run up to? Maybe right there, right? Good earnings. See that yellow line that I drew? That is their that I already factored this in, but this is where they're at right now, at the very top of that line. So they're about to break out of their downtrend. I actually just drew this downtrend just now, before the stream started. So they're breaking out their downtrend. Right, so they're breaking out their downtrend with the news, but there isn't official news. It was just like Amazon or Nike was thinking about buying the company. You know what happened to me? I did all this research. I got very excited. I got into the position on Friday. I did all this. These are one of the plays that I really liked. I was like, yep, I'm doing this. I went ahead and bought the $20 put. I went ahead and bought the $20 put for the 18th. And I went ahead and bought 3 $15 puts for the 18th. Because I was like, I am getting my money's worth. I made a big mistake. I kind of, went too hard on these plays. I went, I should have probably picked, one on the 11th and one on the 18th. I shouldn't have done like the extra 3. But when I got into these plays, I picked a good part of the day to get it in. So my average cost on the 15s are 0.23, and they actually ran up that day to 40%. I could have exited on Friday before market close for 40%. That is big. Like, that's what I'm saying about these, like, having your day trades ready, because like if you go hard on companies before earnings and you're like, well, I want to leave one to roll over. I'll gamble one. I'll gamble one strike and I'll let that roll over. But this one that I'm up 40% on, boom, secure the profits, right? So I didn't do that because I was so sure that they were going to fall. not knowing that Amazon and Nike were looking into buying the company. However, there's no news, so I'm not too worried about that. I'm a little worried about my next week because the expiration's sooner. If you look at next week, I got in at 0.67 and it ran up 40%. This one ran up 40% too. So, you know, it's kind of a bummer that I didn't like, well, let's just secure that, because I could have walked away with 0.93. I could have made my 40% and just walked away. And now I'm sitting here and being like, well, Monday, is it going to run? Because their earnings are Tuesday after hours. You know, is it going to run on the news? So that's what I'm thinking. I'm thinking that Monday it's going to run on the news. I'm not too worried about it, because I am a little worried because I'm going to be 30% out of the money. But if it does run on Monday, I might buy one more of the same strike and just average down. That way, if it does fall off after earnings, I could like sell for a minimal loss instead of 100% loss. So it'd be like, you know, I got this for 67. Monday the market opens and it's priced at 25. I'm like, oh well, whatever. And then it runs up all day, and then my strike is priced at $0 or 0.1, right? Because you can't close it down at 1. So it'd be like, you know what, I'm gonna buy an option for $5. So I have one option for $67, one option for $5. Boom, what does that do? It cuts the price in half. So I have two contracts for like $45, right? Or $35 to $40. So that gives me a better chance that after their earnings on Tuesday, if they fall from like 33 or 34 back down to 25, 24, and maybe it won't be the whole 25, 30, 35%, but it gives me a better chance to make some of my money back and exit the play without losing money or even breaking even. You know, if you have a play going sour and you can break even, that's a win. That's a win for sure. And trust me, sometimes when plays are going sour and they're going sour fast, exiting that play with 20% loss is so much better than exiting that play at 100%. Because if you let it die, everything's gone. But if you just be like, I'm going to take the 20, I'm going to take the 30% loss, you at least have some money back to play another play and live another day in the market that we're in. This market is insane. So I took a big risk here, and I you know, didn't take my exit on any of my plays. But I'm not too worried because, you know, exactly, they are going to sell the news. What news? Amazon might come out Monday and be like, we didn't offer anything like this. Check out this Amazon bike that we're partnered with NordTrack or something, and the bikes are only $1,200, and they don't come with a subscription, and they have spinners on it, you know. Then you're like, yeah, our bikes are better. So you never know, right? So that's how you play some of these, you know. Sometimes you got to take the loss. You know, for me, I might have to find a way to average down, take the loss. But if I hold my calls or hold my puts until after earnings and they fall hard, and then the news comes out that nothing was acquired and they fall harder again, and then we're back to our levels right here of resistance, and they could fall down to my 20, and that $20 zone is pre like IPO run up. Wouldn't that be amazing? Is this company worth that price when they came out? Now they're in all this debt. I could see them hitting these lows. That's why I even took 3 out for the 15, because I was like, you know what? They're going from hero to zero, and I want it to be a little risky. So that's why I was doubling down on some of these puts, but I'm not too worried about it. I made some money last week. I made money in Facebook. I played Facebook, turned $38 into $1,400. I played Clorox. I turned $40 into $780. So yes, I'm taking my gains from last week and playing other riskier plays. But I'm also sitting on a lot of buying power, because I'm like, when you win in this market, when you win these earning plays in this market, be smart with your money. You know, be like, wow, I have $2,000 that I just made off this one or two plays. Guess what? I'm actually going to take $1,000 and put it back into my bank account and go out to a nice dinner or pay off a bill, right? Or you can be like, I'm going to buy some shares. So, I'm not gambling with all these options and all these contracts. And, this market is extremely volatile. So I'm going to put more money into the shares of a company that's already been beaten down, or I'm going to average down. Because if you're buying shares, you are holding, and you don't have to sell in the red until you want to. Obviously, some companies have a hard time recovering, especially in this market, or if their finances are not right. But if you invest into a good company that you believe in, like Apple, and you're like, I'm not going to touch this stock for 5-10 years, because every money I make, every big dog play, every baller play I make, I'm going to take 20% of those gains of that one lucky lotto I got, and I'm going to put it into my favorite stock. So that's that's exactly what you do when you make these gains. You don't just go and be like, okay, I did it, let's go in another play, because then the earnings, the greed, it gets a hold of you. And don't do earnings and don't do greed. This is what happens when you do earnings and greed, right? So I'm not doing too bad. I'm only down 6% all time. So, learning the market. This was learning the market right here. From here down, this was learning options. I was trying to figure out my path. This is me. Look at this. Boom. I'm back to almost even. I had some good plays, and guess what I did? I let the earnings greed get to me. And what did I do with those gains? I went all the way down to zero. I literally went to I had $197 left, and I was just like, I was 20% away from my start. I was 20% away from my portfolio beginning of learning the stock market, and now I'm down 98% again. What do? I took some time off and I tried to figure it out, but I ended up hitting a lotto. I got super lucky, but I wouldn't say 100% luck. I played a play that I did some research on, and boom, it shot me to the moon. It literally shot me to the moon. So if you look at my, I guess my last 3 months, you can see exactly what happened. I went, or actually, yeah, I think it's before the 3 months where I got shot to the moon. So I've only been investing in a year, so this has been a learning experience. And for me to be down only 6% right now feels pretty good. And I've been able to take some money out of the market and to cover some losses and stuff like that and pay some bills off. But look at this. This is what happens when you are addicted to earnings right here. 90%, 90%, 90%, 90%. 90%, 90%, 90%. All these are losses. These are all some of these are earnings losses, and some of these are some of the, AZEC. I was in this for long, and I was actually green at one point on these plays right here. I did not take my profits. So you win some, you lose some, but the thing about this market is you're going to learn, and sometimes you learn the hard way. Eaton right here, the electrical company, that was just a pure gamble. I like the electric company, and I thought they would do well with this, but this was a $26 loss. I paid $27 for a lotto earnings, about maybe 12% out of the money. So, sometimes taking these small losses, they add up. So playing earnings is very risky. So you have to be careful. You can't just and it can be very addicting. And trust me, this is coming from someone that only studies earnings, but I day trade with a lot of plays as well. Like right now in this market, I like Salesforce. I like them. I think they're a great company. I think their chart is very interesting. They're getting a lot of, they're one of the main sponsors of the Olympics right now. So I think like I like this company a lot, so I'm actually looking into a position this week to do a leap in like 3 or 4 weeks, which could be an earnings run up or even like an earnings play, because I see very positive things happening from this company, and their financials and numbers look great, in my opinion. So let's go out to y'all. What kind of questions do you have? This is literally, I've been rambling on right now. I've been rambling on for an hour, almost an hour, and kind of breaking down how I find these plays, the research I do, how to pick my strike price, how to pick my direction, how to add it to a watch list and then monitor it. Don't sleep on the watch list. If you are using Robinhood, you know, if you like a play but you want to have a better premium of getting into that play, add it to your watch list. That way you get an alert. You literally will get an alert on your phone, be like, this item on your company on your watch list is down 20%. And then you click it and you open it up and you see it live. You're like, wow, they are down. The premiums are a lot cheaper now. And then you're like, what, I want it to fall a little bit more. Boom, it gives you another alert. The company on this watch list is down 50%. Or even 100%. It'll tell you if it's down 50, 100, or 20%. Those are some good notifications on a very hated brokerage. Like, I mean, I don't have any problem with Robinhood. I don't have $25,000 in my account. I can't make unlimited day trades, but I am very, very patient. I save my day trades for sour exits or quick cash when I see something, and I'll just load up and I'll get out 15, 20, 30 minutes later and make some quick cash. But you know, you have to know your limits. You can't just be like, run through your day trades and then be like, I'm gonna swing this. I'm gonna swing 10 contracts without having a day trade available into earnings. And what happens? It goes south and you're like, well, I was up 150% before the market closed. Well, I didn't have any day trades available. I didn't want to sell and lose my restrictions for 3 months. So you got to take all these considerations in when you play in this market. All right, so back to you guys. Hope y'all have been enjoying yourself. I might have to take a sip of water. Man, my throat. So we got Big Mama. She's like, what do you think about Disney? What do you think about Uber? Great companies. Disney, Uber, right? So we already saw that Lyft was, you know, going down a little bit. They were in debt, but they were kind of coming back to life. So they cut their debt by half, but they were still in debt. I remember thinking Uber was a great price at $42, and that's just me. And if you look back at them, their high is what, 60? So this is a pretty dramatic fall. You know, a lot of companies are like this, where they ran up in 20, or they ran up last year and then they fell. And you know, this company is what, 22% down for the year, or for the 3 months, and 36% for the year. You know, they're hurting, right? So what do we think about Uber? What do we know about Uber, right? So let's get back at it. Bruno says buy calls on Disney. I didn't say that. Bruno said that, right? Uber. So it looks like they're in like kind of like a downtrend, like a double top drop, and then you know newer low, right? So you have the newer low, you have right here, boom, they bounce right off that stability. That's a nice little bounce right here. See that? Bounce right off that. That's a good stability zone right there for them. Um, so we like that bounce right there a lot. Let's look at the financials. Wow, 8 billion, 6 billion negative for 19 and 20. So, oof, that is rough. They had COVID hurt them a lot. Jeez. I mean, you have to think about it. People were just staying at home. They couldn't go to the bar. They couldn't go anywhere. No one was calling Ubers and Lyfts, and people were riding their Pelotons, thinking they were going places. But yeah, that's rough for Uber. But look at this. So quarter one, 100 million. But boom, 1.4 billion net income. That is great. But then they answer again with quarter three negative 2.4. Ouch. What happened there? So if we look at quarter four last year, negative 968, right? And they report February 9th after hours. And let's go to Wednesday. Let's find Uber. Uber, there you are. Oh, it was at the top. I just couldn't find it. So their consensus from last year are better. So that's good. This is very, very good. Not sure what this number means. Number of estimates, and that high number being high. I don't know technically what that means. It's just like, are there other sources given their different consensus forecasts? I'm not too sure, so I can't answer that for you. So you look at their consensus from last year. It looks great. Still in debt, but better numbers than that. Okay, so their market cap is 71 billion. They have 33 million volume. Their average. That is a lot of volume. Right here, they had 100 million. Jeez. That Uber was probably some big news catalyst right there. What did they do at last earnings right here? They took off. They went up, okay? Bounced off new stability. I think like people like this company a lot in the long term, but it really comes down to their financials of this earnings play. And it being later in the week, you don't have to get into it Monday. You can watch how it acts on, Monday and Tuesday, even Wednesday, because it's after hours Wednesday. So you can watch it Monday, Tuesday, Wednesday, all 3 days. Yeah, I'm playing the Chrono Trigger original soundtrack for the Super Nintendo. So some of the music can be very intense, right? Dun dun. So you think about it, they're still struggling. So they could, in my opinion, they could test this bottom again. They could. Let's check out the puts. Let's check out the puts for the week. And what did we say? $32.96 increments. I'm going to add the 33 put to my watch list. That way, on Tuesday and Wednesday, this thing on my watch list, it will tell me if it's going up or down. And that gives me a better idea of how the stock moves. Now let's see that it has a good week. And we'll see this high right here of the original, or of this stability zone. Let's say this high right here of $42. Let's say that you think that, with good earnings, it could test that high of that stability and maybe break out. So let's put the $42 on our watch list. That way I'm not going into a play, but I'm going to watch it because it's later in the week and I can see how it fluctuates. Now let's go to Disney. Disney. Average volume 12.8 million, right? That's not bad, right? All right. don't pay attention to my lines. I drew them a long time ago, and I like to look back and reflect on how my lines have changed. So this bounce right here, wow. So this is their before the COVID. So 152 is what they were trading at before. They kind of fell off, and they just bounced off the 129. Wow. I can't believe Disney hit 129. That's insane for a market cap of 258 billion. This company is huge. Their revenue is like almost 70 billion a year. That's like a fourth of their market cap. 25% of their market cap. So you have a lot of people invested in this company too. When you see the market cap like really steep compared to their revenue, that's kind of a red flag. Like Facebook's market cap was like, I think 8 times its actual revenue. Oh my gosh, that is insane. Their market cap was 985 billion before this happened. I'm telling you, those are things to look for when you're like, okay, why is their market cap 980 billion, but they're only bringing in 117 billion a year, correct? Or actually, if you look at it, that Q4 just came out. I was comparing this to 2020. I was like, they only have revenue of 85 billion, but their market cap was 900 and something. That is ridiculous. What is that? Like 85? How many times does 85 go into 900? It's like, what, 9 times or more, because, you know, that's a ridiculous market cap. And look at their market cap now, 645. That is why you saw that sell-off, because the market cap shows you how many people have invested in this company, how many whales, like, you know, one whale could have, you know, 50 million in this company, and another like company could have, of their whole company, could have another 200 million. But to sell off 300 billion, that is incredible. That is incredible. Like, how, like that play, I saw this play coming, but I didn't really think that would happen. I put the calculations together. I was like, their market cap is too high. It doesn't make any sense. I was like, yes, they're going to beat their earnings. Their quarters look good. Look at their last year, 2020, to this year, 2021. They killed it, correct? That is 85 to 117, 29, 39, 33% profit margin to 33% profit margin. So their profit margin stayed the same. But why was their market cap so high? And when they came out with those numbers, there was something about it. Hey, their financials are looking good from last year, but there was something in their earnings report that investors did not like, and that caused them to sell off 20%. They actually ended up selling off 25%. And when you talk about 25% for a company that's trading 328 a share, that is a big drop. They fell to almost 228 to 240, right? They fell almost $100 on that. And you know why? That's because their market cap was way too overvalued for the company. And those are things that I looking for. And of course, being Meta, being a heavily traded company, I saw an opportunity there and I took it. And I turned $38 into $1,400. And I will show you that I'm not making this up, that I play these earnings, and this is why I picked it. Right here. And I kind of am a little upset because I paper handed a bunch of other contracts that would have made me another $7,000. But I don't want to talk about that. But I turned the 255 that I bought for $38 right here on the February 2nd. I turned that into $14.95 that I sold on the 3rd. So there you go. That's how you play earnings right there. That is how you play earnings. Going meta and losing ground to other platforms and losing money on the Apple dealio, and the lawsuits and all. They knew that, it wasn't going to be good. I agree. And I agree that like when Facebook fell, that other companies fell too. Like, I mean, it's kind of hard to say like what companies fall, but when you think that Facebook is going to fall, and like say I bet against Facebook or Meta platforms, I bet against the Meta platforms. You could have been like, well, let me take a look at Twitter. Let me actually just go ahead and buy a put for Twitter, 20% out of the money for fun. Maybe it's like $15, $20. Oh, I got a better idea. Let me go buy a Snap put. That's 20% out of the money because wait, that's a social media platform too. And guess what? If you took one and one, if you added the numbers together and like you played this play and then you put one and two together and made that kind of observation, you could have done well, because what happened to Snap fell 20% with Facebook before the earnings. They fell 20% with Facebook before the earnings. Then guess what? Their earnings came out. They already had the fall off when their earnings came out, and it was the opposite of what Facebook made them, what happened to them. Then they went up double that. They didn't go up to 20%. They went up 40, 50, 55, 60. They almost went up 60% pre-market, I think. Something ridiculous. And they sold off at 9.35 to 40%, and then they finished the day at 65%. That is insane volatility. You know how insane that volatility was? It was 550%. Snap was trading at 550% before their earnings. Pinterest was trading at 500% before their earnings because of all the hype of Facebook. When you play a play like that, you are risking so much premium for a lotto that it's not even worth it. I wanted to play Snap, I wanted to play Pinterest, but you know what? I said the volatility scared the hell out of me. It scared the hell out of me. And I stayed away. I didn't want to pay for those insane premiums. But what did I do? I did a little research and I found Clorox. And boom, what did I do with Clorox? I took a put for $150 for $40 on the 3rd. I was like, I gotta pick a play. I got this money from Facebook. What am I gonna do? I picked Clorox. And I turned $40 into $7.80. What was that, a coin flip? Absolutely not. I did my DD. I did my research. I went into Clorox and was like, looked at their financials, and then I looked at their COVID run. This was one of the big COVID or 2021 stocks. This company did really well last year. And, they went from 100 and they went from like 2020. They went from 130, 140, all the way up to 230. That's an insane run. And where are they at now? I mean, they're back down to 160. Why did I pick the $150 put? Because I went to their quarterly reports and I looked at their revenue that was coming out and I compared it to last year. And I was like, well, Q2 last year they had 1.8 billion, but their net income was 259. This time they're only having 69 million, but the same revenue. I said, that is really, really bad. Like, if you're gonna run, if you're gonna have that run up to last year, you need to have your numbers look good. So I actually went and got a Clorox put because the volatility for the IV was at 60%, and the premiums were $40 for 18% out of the money, or it was like, you know, yeah, 17% out of the money. I took a risk, and the expiration date was actually February 18th, so it gave me even more time for my play. I could not hold it over the weekend. I got scared and I sold it. I sold it like maybe around 10 o'clock or like 9:55. I patiently waited. I think I sold it around 10:10. I patiently waited there. Sold it at 10:03. So I mean, if I didn't, I could have sold it at market open for boom. I waited patiently, sold it at boom 10 o'clock. I was very happy with the money here. I could have waited a little bit longer, made some more money, but I'm not mad at all. And that's what I did instead of playing Snap. And that's what I did instead of playing Pinterest, because I thought the risk and reward for $40 for 15% of the money was way better than paying $300 for something 25% of the money. I would, if I'm playing $300 for anything in an earnings play, I'm probably not swinging that at all. You got to be kidding me. Like, I mean, unless it's Tesla or if it's Amazon or if it's like a very big high cap and, you know, the premiums are that much. Okay. Where do you see volatility? So when you click on options for Robinhood and you pick a strike. So I wanted to buy the 145 call because I think it's going to come back up next week. Just hypothetical. Or whatever. Sorry, my brain's not working right now. Just the volatility is right here. So it's trading at 35% right now. Very, very low. But let's look at a high volatility play. So something Monday. We looked at On Semiconductor. So they're reporting. Let's look at Energizer, ENR. Because they're reporting Monday pre-market, so that means that maybe they had a lot of activity on Friday. They sold off 7% Friday. Jeez. And their volatility was only 55% actually for the calls, but for the puts, not too bad actually. Energizer might have been a good play to play. Depending on their finances, depending on their numbers, depending on how you're going to pick the strike price, depending on, you know, your DD. So you don't go to an earnings play and play the opposite. Sometimes you need to take time to do the little bit of research before you play and play something like an earnings play. I'm going to go back out the chat. What other questions y'all have? Because I'm pretty confident that I covered a lot on how I play things, what to look for, and all that good stuff. Also, if y'all like the content I'm providing, shoot me a like, shoot me a follow, subscribe. So you're notified when I do go online. You know, come hang out, check out what I'm doing, see what I'm looking at, because you know, you will see these plays that I put in my watch list. You'll see some of the things that I look at, and then, you know, I like engaging with chat and conversating and just talking about whatever. So I'm gonna stream for another 7 minutes. It'll come up to an hour and a half, and that will be it for me. So, yeah, I'm leaving it on for you guys. Tuesday we got Pfizer, right? We got Pfizer. I like Pfizer right now. PFE. You know, with Pfizer, I think it's very undervalued. This run up is like nice. However, for the company coming out with, you know, 8 billion net revenue, or sorry, excuse me, their net income was 9 billion for 2020. Just for one quarter was 8 billion. They are looking at to double their last year's EPS just for this quarter. But if you look at like all the other numbers, they are like doing so well financially. These are great growth. And you look at the market cap, 297 billion, and you look at their revenue, about 50, or I would say 50 give or take, after, you know, 25, 45, 60, 70, 80. So say they have 80 billion for 2021, which is what we're gonna see, I think, for 40. Yeah, say they have 80 billion revenue. That is double from 2020, and their market cap is 297, so 860 and 2432. Not even 25% of, like, not even 4x. The market cap is not like excessively, like, highly invested with whales and tons of like I don't know, tons and tons of people having shares on a company. I don't think their market cap is like blown out of proportion. I think this is a good company, so I see Pfizer as a good play to the upside. Why? I don't know. I mean, I think it's they're doing well with what they're doing. I think, you know, as long as they keep doing research with other medicine and pipeline and stuff, I don't know like what makes them compare to Moderna. I mean, I think Moderna is definitely a lot bigger, but 41 billion, 80 billion, right? This is what we're seeing for this year, and Moderna is, what the fudge? Like, why is Moderna 800 million and their net income negative 747? I mean, look at their numbers for quarter one for 2021. Like 4, 5, 6, 7, 8. What the hell? 5, 6, 9, 10, 11, 12, maybe 13. Moderna has revenue of 13 billion and Pfizer has revenue of 80 billion, yet Moderna is priced at $163 and Pfizer is priced at $63 or $53. That, see, when you do this kind of like research and stuff and like compare it to other companies that are in the same sector, you kind of wonder, why is Pfizer not valued higher? Why is Moderna overvalued? You know, especially, I mean the numbers look great right now, but like, I mean, I did a little research on Moderna. They're doing like good stuff with their pipeline. They're gonna like doing HIV and all kinds of like testing, and so they're trying to, like, you know, when those catalysts and trials come out, those are big for the company. But why is Pfizer that is like 4 times more revenue than Moderna, price $100 cheaper, and Moderna ran almost to $500? So you put 2 and 2 together, and then you're just like, well, Moderna reports February 23rd. Like, okay, I got an idea. I have a great idea. I am going to draw a line down here. Here's the low. Here's the low low. Here's a low 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 low. Boom. I'm going to just draw it right there. Just because of my chit-chatting with you. $100. 104 is that low. So let's go. Let's freaking go. 24th pre-market. Their earnings are coming out. Yeah, their numbers look great, right? February 25th. Let's go a week out. Let's go to March 4th. Let's look at a put for $100. That's right. 111% volatility, only 0.76, 38% out of the money. I don't know. Is that worth the risk? Do I think that Moderna is overvalued and then they'll fall back down? Because the numbers don't lie. When you look at these numbers right here, yeah, you see this chart and it looks great. But compare that to Pfizer and the money they are making, and the price of this company is $100 more. You start to think, doesn't make any sense. And look at their income. So they don't even have $1 million revenue for 2020, yet their market cap is $66 billion. Remember when we talked about Facebook being 9x? That is 66x. 66 times the market cap is higher than the revenue. What is going on? That is insane. So think about like a sell-off after earnings. Yeah, the numbers look great, but should they be priced at this? Why did I pick the $100 strike for $75? Let's go out even further. Let's buy a little bit more insurance. Let's go to April 14th before the big jump to May. Let's go down to $100 put. $224 with 88% volatility. Right? Do I like that? Maybe not so much right now. So, that's kind of expensive. But let's go 1 month out after their expiration or their earnings play, and let's go to that $100. Ooh, that is very spicy right there. See, that is a gamble I'm willing to take. 40% out of the money, March 25th. I like this gamble. I'm going to add it to my watch list, and you know what that means. Moderna on a down day, right here, that premium of that put is going to be more, correct? So what happens when Moderna runs up next week with Pfizer? Pfizer reports good. Moderna runs up with it. Right when you see that reverse, right when you see that reversal, boom, you lock in that watch list target, and then I get that premium at a very good price. So that is what I did with Facebook. That is what I probably should have done with Netflix. I didn't even look at Netflix. But these are the things I do when I look at these companies. I'm like, well, they're doing really well. Let's compare them to another company in this sector. And I know I said I would stop my stream at 9:30, but just looking at Moderna and comparing it to Pfizer, that right there kind of got me a little excited, and I kept going. And like when you do these kind of DD, it becomes like a black hole. You can get sucked in. You can just really like try to figure out like the best play. So cool. All right, enough of that. Enough of me rambling on. I hope y'all enjoyed everything tonight. I hope y'all had a good time hanging out with me, Mr. Penguin, Kojin. Please feel free to ask me any questions in Discord. I usually post in my own channels as well as like the earnings channel. I like the earnings channel, but I stay pretty frequent in all channels and try to provide positive feedback. If I have a smart ass mouth, you let me know. Sometimes I get a little cranky, but hope y'all enjoyed everything tonight. This is kind of a little bit about how I do research on earnings, and I pretty much broke everything down for you. This is going to be uploaded on my YouTube channel, so if you missed it, if you want to go back and look at some key points that I made, it's going to be there. It's not going anywhere. I'm trying to grow into being more of a content creator. I used to be a big streamer for gaming, but I'm getting back into it with the stock market. And I hope y'all like what the way I'm taking on the market. It's a little bit of a different approach than people that, you know, constantly have their three stocks. They're like, yeah, you know, let's only talk about Tesla. Let's only talk about Apple. You know, that's fine and all, but for me, that's boring. So if you like my flavor that I put on some things, shoot me a follow, subscribe, and feel free to ask me any questions on Discord. I'm pretty straight to the point. I don't beat around the bush. I'm very transparent, and I just say it how it is. That's how it is. And I want to play some exit music, pop off cam, and maybe stick around for like 5 more minutes. So hope y'all have a good night. And until next time, peace.